Hi there, this is Helen Tarrant again from LA. Here with our whole team. Wow, it's massive. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to talk about the yield gap with your interest rate rises, right? Everyone is talking about it, and this is why I feel like I should make a video about the yield gap. So with the interest rate rises, a lot of people think that they can sit back and basically the vendor will adjust their expectation and that they'll just magically get an extra 0.5% yield in the commercial property space. Well, that's not the case. Sorry to tell you that. And the reason for that is it's on demand and supply. Like I said before, that more demand, less supply means that you pay more for a property. And that happens no matter whether in residential or commercial. Yeah, that is what it is, right? And whereas interest rate rises has slowed down the residential market, it hasn't put residential market off a cliff, and with commercial, it hasn't slowed it down. It just meant that residential property investors are actually jumping ship to the commercial property investment sector. And what we're seeing here is that people are looking at the yield gap. So what exactly is the yield gap? A yield gap is what you make between, and it's really what the bank makes, exactly what the bank is doing. You're doing it at the same level. So it's what you're getting an interest rate from the bank and what you're making on the property. So for example, your interest rate is at, say, 4%, and you're getting a 6% yielding property. The yield gap is 2%, right? You're getting the yield gap. And that is really important because if interest rate goes up and your yield gap is lower, then you have less and less margin, right? So you can call it can be the margin between, your yield and your interest rate. In fact, this is exactly what the bank does. So what the bank does is that the bank gets from the RBA a interest rate, right? Interest or loan or money at 0.85, which is the current cash rate. Then they add their 2% margin on it. And it becomes 2.85, right? But the thing is, they also look at not just the cash rate, they look at, what it costs to lend the money, the swap rate, and it might be that it's actually 1.5% by the time they add all their costs initially. So when they lend it out to the investor, they need to add that margin. And typically that margin is anywhere from 2% to 2.5%. And this is where the bank makes the money. That 2 to 2.5% puts the interest rate somewhere around right now, 3.5 to 4%, which if you haven't experience that, you may be getting that in the next 6 months or the next 9 months, definitely. Now, you want to make the same arbitrage. You want to make the same returns or the same gap as the bank does, which is, roughly that 2%. Now, if you're going to be in a metro area, Sydney, Melbourne, Brisbane metro, forget it. You are not going to make that yield gap. You're not going to make the 2%. At best, you're going to be making 1 to 1.5%. Now, these areas, because of the capital growth of these areas and the history of the capital growth of these areas, most people can afford to still buy properties at 5% or 5.5% because they're going to get essentially 5.5% on their deposit rather than on the overall leverage of the property. And if they get that, it still means that the property could be still work for them quite well in terms of future capital growth. So they're getting a 5.5% return on the deposit, which, can be more than what they're getting at the bank, which might be 2% at the bank, well, they're now getting 3.5% more. So they're getting more for the deposit. But what they're also getting in the back end is the capital growth. They might be getting an extra 2% in the capital growth than they would in regional, and that will outweigh what they're not making on the leverage of their loan. And this is why metro cities' yield gap is not going to increase, right? So you might see Brisbane go back to a 6. You're definitely not going to see Melbourne staying at a 6 for a long time. Sydney hasn't been a 6 for years, and it probably won't be a 6. If it is, you'll have something that blips up and goes again. And even if the interest rate goes up to 6%, Sydney's not going to go to 8%. So these are the areas that's not going to happen. So you're not going to make that yield gap. So this is where you have to think, do you want to be in regional, right? Because if you're in regional, you are going to make the yield gap. So if your interest rate's at 4%, regional areas like Rocky, Townsville, Fringe Cairns, Bundaberg, and maybe Gympie, you're still going to get yields of 6+. So you're going to clear that 2% margin, maybe more. And with the interest rate rises, potentially in 6 months' time, you could get a 0.5% more. So somewhere like Townsville, who's been 6.5 and 6.25 for the last year or so, will probably maybe go up by 0.5%. You might be getting 6.75, you might be getting 7%, right? And that means that as the interest rate goes up from 4 to 4.5, you're still clearing a 2 to 2.5% margin. Now, there's also the rationale that a lot of people are going to now decide not to invest in Metro because they really need cash flow for the next 2 years because their residential portfolio really, really needs it. So one of the things that happens is that with Resi, you are not going to get the yield gap at all. In fact, your yield gap is negative, right? So if you're at 4%, and what you're seeing is that 1% rise from 3% to 4%, you're making up for it by cash out of your own pocket, right? So you're in negative territory again. And to make up for it, you're going to need a commercial property with the cash flow and that yield gap to be able to subsidize it. So what you see is then more people are going to choose to go to regional. And when you see more people going to regional, the yield then starts to come down and the yield gap starts to shrink, even in regional areas. So if you are thinking of going to regional for a purchase in commercial property, can I please advise that you do that now? And not only now, as soon as possible. And don't whinge about the yield being 6 or 6.5 and you should have back in the day got 7 or 7.5. The thing is, with an influx of people who've decided not to invest in Metro, you are going to see, as the interest rate rises, more people jumping into regional properties than you are in Metro properties. And hopefully that will bring Metro properties back a little bit more. But you might find that because the capital growth is so good in these areas like Sydney and Melbourne, that most people are happy to hold because they know that capital growth is a long-term game and they're happy to hold for the next 5, 7, 10 years to get that capital growth, which when it clicks in would actually outweigh what cash flow they get. And for some people, if they have the cash flow from, having a high-end job or they have the cash flow coming from their business income, that hold is insignificant, right? So they can hold it. But if you really do need cash flow, then regional is going to be pretty much your only choice as the interest rate rises for you to make that gap. So that means that at every $1 million, you're borrowing at 4%, which means there's $40,000 in interest repayments. You're going to get $60,000 or $65,000 net rent, which means you're clearing $20,000 to $25,000 on a regional property. Now, as the interest rate goes to 5, you may get to a 7% yield in regional, which means you're still clearing that $20,000, that 2% gap. But as it goes to 5.5 to 6, I don't think that regional will actually go back to 8 or 9 again, even in areas like a Townsville, a Gympie, Bundaberg, at Cairns. You might see it in more regional areas like a Gladstone, a Mackay, like Emerald or Blackwater. You will, maybe even Rocky, you might see the yield scale back again, so which means it goes up again, because those areas are less of a ideal choice for investors because they're a little bit further out. Single driver industries not as favorable. So when the interest rate rises, most people look for a balance. They're going to go to slightly larger regional towns. So you'll find that potentially you can clear 2 when you're in regional, perhaps going to 1.5 into the future. So then the question comes in, if you're buying a self-managed super fund, what you should be doing. You're faced with the same yield gap as other people, so, but even worse, because self-managed super funds start at 5%, going upwards. We're going to see 5 to 6% now. Now, when I started in self-managed super fund back 5 years ago, it was at 6%. The lend was at 6%. And then it went down and we were able to get for a short time about 3.5 to 3.8%. Now, what you see is that will go back to 5 really easily, and you potentially hit late 5s or early 6s. And that's kind of a scary thought. Now, one of the benefits of investing through a self-managed super fund and the yield gap is that you'll find that your deposit is worth less in self-managed super fund because there's only a limited amount of places you can place the deposit, and it's diminishing the longer you leave it there as cash. So if you don't put it into a property and you don't leverage it, that diminishing asset is actually worse off for you in the long term. And as such, you're better off investing in a property, even if you make very, very short yield gaps, because, or very small yield gap, because if you don't, that deposit erodes away, less borrowing power, and pretty much you're sitting there thinking, well, my retirement is being eroded away. So the best way to do that is potentially invest in something that gives you a bit of security, which is something in fringe areas, in suburbia, where you're going to get a little bit better in the yield, but not a huge amount like regional. I mean, of course, if you can afford to go up, if you go into $3, $4 million, $5 million, you're going to find that the yield is going to be better than if you're a sub 1.5 million. But if you are in self-managed super fund world, and your interest rate is at 5 or 5.5%, ideally you want to clear 7.5%, but you're going to have to be in Mackay and extreme regional if you want to be in 7.5. So the potential of that is maybe going back to an area and getting close to 6%. Yes, when the interest rate rises, you are going to find that you are, for the portion you have in the loan is going to match what you have in your interest in the self-managed super fund, but the portion that is not, and in normally self-managed super fund, you get large, you have to put in with large deposit. The portion that is not, you are going to get that 6% yield, and it's going to give you that more of a return, and that's going to add on to increasing the value of the property, but also the cash flow load, because you need to put more cash into your super to really continue the growth of your investment journey. And what we've seen recently, we were about to hit the end of financial year, and you're going to have one of the worst reports in the super funds, because it's totally tanked in the last, since interest rate rise in the last month or so. So that also incentivizes you to come into self-managed super fund space and invest in commercial property, even at a rate where you might find that your loan matches your yield and there's no yield gap, but at least there's security, and there's your deposit is not being wasted, and there's a leverage on your deposit, and you're getting returns on your deposit that's above market and better than what you can achieve with the industry fund. And also in the future, the growth of the property is going to pay you back in kind. And really, when you're looking at that yield gap, if you cannot close the yield gap because you are worried about being a regional, you're security scared, like you basically want something really, really secure, you need to be back in metro. You are not going to make a yield gap. What you're going to do is only get the returns on your deposit, and that may be a holding pattern you have to hold for 2 years. It's not going to be forever, but it may be a 2-year process for the interest rate to come back down again for you to make more cash flow. But in that time, as the interest rate comes down, you'll find the property will go up in value more than it would in regional, and so it will be worth your hold and not having that yield gap in the long term. But again, now is not a time to short-term invest in commercial property, speculate. It is to invest if you're looking at specially set and forget long-term investments, where you're looking past the next 2 years, you're looking at 3, 5, 10-year investments. That is where that gain will come. And yes, for a while, the yield gap is going to compress pretty sharp, and for a while, you may have very limited cash flow, but ultimately, commercial property is a cash flow game. You will get your cash flow back, and you will have the capital growth in the back end. But if you can, and you want to be in regional, and you're not scared, and you're willing to take a bit of risk, go regional, go now, because if you don't, the influx of people that's going to go into regional will drive that return down, and you'll find that you will have even less returns, and that yield gap will be much more compressed. Whereas if you go now, you give yourself a head start for the next 12 to 18 months, potentially 2 years as the interest rate rises, which allows you for 2 rises in rent, which will give you even more of a buffer going forward. And on that note, if you want to ask any questions, reach out to me below, helentarrant.com. Jump on there. Really, send me an email. Let me help you build a portfolio, cash flow portfolio through commercial property. Let me show you the strategies. Let me work with you, partner up with you, and we can go together. So in the meantime, subscribe, hit the bell, and I'll see you in the next video. Bye for now.